Yeah, my people. I don't know what happened there. Something, I don't know. The stream just cut off from nowhere. But yeah, we got about 3 minutes left. Don't forget to smash that like button. We got 3 minutes left until the FOMC meeting. We will listen to Jerome Powell. We will listen to what he says. I will comment in the background. I will not talk much. I will let him speak. But I will comment if I hear something that I know this is bullish or this is bearish. So you will hear me say bullish or bearish. And we will see how the market reacts. So we will have the chart here next to it. And that's how we will go. So, and we can expect this press conference to be for about, I think it's half an hour normally, but sometimes it extends a little bit. So we can expect it to be about 1 hour, just in case. And what we want to do is, let me get to this, to a blank chart. You want to see BTC break out of this range that I spoke on the previous stream just now. We are stuck on the upper resistance. Market has priced in already that we have in a QT easing. Sorry, that they will stop QT. So what has happened is this. Well, let me lower this volume here. So what has happened is this. Just now, I'll see if I can find that tweet. 1 second. Oh, here it is. Give me 1 sec. There it is. So FOMC statement called it QT starts ending in April 1st. All right. And this is very important. This is very bullish for the market. Market needs QT to stop. I explained it already on the previous stream. Quantitative tightening means reducing the money supply in circulation. And that is not good, of course, for risk assets. You want to pump in money to circulation for people to become more risk on, you know, and crypto is definitely a risk on asset, so, or risk on investment vehicle. So this is very bullish. We can expect, and this is also what the market expected. Hence this pump that we have seen since yesterday, or sorry, today. No, since yesterday actually. But with this confirmed, I thought we were going to get a sell the news event, but with this confirmed, where is it again? There. We might actually get more pump because now we have it confirmed, but we will wait until Jerome Powell says so, and that will really confirm it. And that is when I think the markets will react to it. So I was very bearish just a couple of minutes ago on the stream we had. I was saying that we probably will get a sell the news type of event, but right now, I don't know. It's a tricky one. It's a tricky situation. We will see. Is this priced in or not? But I'm expecting actually the market to push up a little bit. And even if we stop pushing up here, it doesn't mean that we are in a bull rally still yet. All right? Okay, so let's listen.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent.
Let's see if we can get the stream back on.
Measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Funny thing is, if it says something crucial now and the market reacts.
At today's meeting, the committee decided to maintain the target will be 3.9% at the end of this year and 3.4%. Will be 3.9% at the end of this year and 3.4%. Will be 3.9% at the end of this year and 3.4%. Our current policy stance is well positioned to deal with the risks. Our current policy stance is well positioned. While market indicators continue to suggest that the quantity of reserves
Yeah, my people, I think it's actually their stream that is bad, because I have something else going on in the same time on another screen, and it's...
While market indicators continue to suggest that the quantity of reserves
Yeah, man. Jack, you remember that. Every time there's something important to say, this stuff lags. But yeah, man. Like you see here, for example, the chart moves with no problem. Yeah, exactly. To hide info. Yeah, we'll see.
While market indicators continue to suggest that the quantity of reserve.
Come on, man.
While market indicators continue to suggest that the quantity of reserve.
All right, this is not working. Give me a sec. I will see if I can find some other stream. This is from the Federal Reserve themselves, so it should be good. It's actually the first time I see their stream lagging. We have seen that from the White House, but not from the Federal Reserve.
While market indicators continue to suggest that the quantity of reserve. While market indicators continue to suggest that the quantity of reserve.
Yo, come on.
And that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby. Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer inflation expectations are mostly well anchored. If you look at the New and in break-evens, some higher inflation over the next year must be related to tariffs. we know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But
show consumers, at least in the short run, expect higher.
Well, obviously the internet is very bad. This is actually the first time this happens. I am sorry for this, but I don't know what to do with this stuff here now. Trying everything.
closer and closer to that. I wouldn't say we were at that.
Well, it seems like they're saying something positive because the market is moving a little bit, but
Up by 0.3, and so those kind of balance.
oh man, this is a mess. Give me 1 sec. Let's see if I can do something to get this thing speeded up a little bit.
Up by 0.3, and so those kind of balance. And again, we think our policy is in a good place. We think it's And again, we think our policy is in a good place. Going to keep getting, relatively high productivity. We've got
Yeah, this is not working, guys. I don't know what's going on with this internet, man. First time it messes this up like this. We got fiber internet here, so it should be absolutely no problem. But obviously there is some problems. Like you said,
going to keep getting, relatively high productivity. We've got
It doesn't work, my friend Lyridon. I opened a new stream and still it lags. So I don't really know what to do anymore.
going to keep getting, relatively high productivity. We've got unemployment,
labor and inflation just across the economy. Have we started to see?
This is sick.
Labor and inflation just across the economy. Have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise.
Just a sec, my people. I'm changing the Wi-Fi here. We'll see if that works.
Have something to do with, it's either noise and have something to do with, it's either noise and time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment, and if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with to take on, to allow. Very reluctant to take on, to allow prices to go up at the same time for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not what that's We'll say this, we don't make such a forecast. If you look at outside forecasts, forecasters have generally
I guess last night, President Trump fired 2 members.
Well, we can enjoy the market racing. Man, this is a disaster. What a fucking mess. I think this must be one of the most annoying streams I've been on.
I guess last night, President Trump fired 2 members.
So I think I did answer that question in this. So I think I did answer that question in this very.
Well, not enough that Jerome Powell is already an annoying person. Now this also. Well, it is what it is.
I'm just wondering, are you dismissing that, what we...
Yeah, I'm giving up in the stream, guys. I'm sorry. He's basically confirming.
saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to
Yeah, guys, in the meantime, what I'm doing is this here. I will explain a little bit. So y'all with me on the trading. I will close half this position. Why? Because we get an order block here. So I'm closing
an outlier compared to market-based and compared to other
boom, like that. And then we let this thing continue and see if we can see some more positive things. So the little thing I've heard so far, just to get something going here, it's that he's basically confirming what was expected, but
an outlier compared to market-based and compared to other.
Get bullish a little bit. So I'm trying to find some updates here on the sideline, but this here is mega annoying, man. Most important stream, and it's lagging. What's happening now on the BTC chart is that we need to pass this order block.
An outlier compared to market-based and compared to other.
All the way up to 86,600 approximately. Let's say 87, just to be sure. We need to pass that. We need to break through it. All right. There's a big chance that we get into it and react bearish to it. because it's a bearish order block. This
An
is a
outlier
supply
compared
zone.
to
We come up
market-based
here,
and compared to other.
supply, and we dump. My microphone, 1 2 1 2 1 2. Is it better now? I don't want to have it too loud. Ruben, yeah,
An
let me check
outlier
gold as
compared
well.
to market-based and compared to other.
Let's do like this. Boom. Damn. We love to see those candles. All right, gold. Let me first just quickly check NAS, because right now
Outlier
BTC is
compared
also
to
following NAS a lot.
market-based and compared to other.
Sorry, not even now.
Other survey-based
Not S&P 500. That was S&P
assessments of
500. This is
longer
NAS.
run
You can see it's a
inflation
very similar
expectations. So we got to
chart
keep that
to
in mind. And
BTC.
I would just say
similar
we
patterns.
look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Gold. Here is gold. Yeah, and by the way, so what is bullish for
Michael McKee
crypto is
from
bullish
Bloomberg Radio
for
and Television.
gold as well.
There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well. Which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly. Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. We came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored. We're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed, there's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down, they tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. But, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. You know, sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, you know, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that, or sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, you know, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any kind of things. We don't dismiss that. We're watching it carefully, but those kind of things. We don't dismiss that. We're watching it carefully, but
the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, you know, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, you know, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. You know, inflation, underlying inflation is you know, still running in the 2s with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
That tariffs are already having at least some impact on inflation. that tariffs are already having at least some impact on inflation.
Really a range of possible outcomes. Really a range of possible outcomes. Really a range of possible outcomes. Came together very strongly behind slowing, not pausing. Came together very strongly behind slowing, not pausing. Came together very strongly behind slowing, not pausing. You can take our time getting there. You know, we're shrinking the balance sheet. You can take our time getting there. You know, we're shrinking the balance sheet.
Yeah, guys, what can I say about that? That was a mess to a stream. Nightmare. But it is what it is. The important thing is the market is reacting positive to it, right? So let's throw this shit away and look at the charts quickly just. Boom. All right, cool. So I'm still very suspicious about this this pump. And why I'm suspicious to it is because it already pumped so much, and actually Jerome Powell, he didn't say anything new, like from what I could hear, because I think I caught like 10% or 20% of his speech and his answer on the questions. I was trying to watch Twitter at the same time and see if because people post very fast there if there's something. And by the way, if you don't know, if you want the latest news fast in crypto, then Twitter or dedicated Telegram pages is the best. Or I'm gonna call it X, not Twitter. Give me 1 second. I'm gonna go scroll through channels here, but basically there was nothing new. He just confirmed what was already said. And when I look at the markets, we have created bullish structure. It's good. But what is not good is that we didn't manage to break through this order block here, all right? So I want to see market probably come down to this level here, structure level, also an order block. And bounce up, just like the arrow I've drawn out. That is what I'm expecting, but okay, now I see why the markets are bullish. So what we missed is this here. Fed Powell just said we have to cut QT in half, and we will approach the QE level slowly. Ultra bullish for markets. So let me dissect this. Let me explain this for you. I was talking about QT before, quantitative tightening. It means they take out liquidity from the markets. They remove liquidity from the markets. How do they remove money from the markets? By basically selling bonds. All right. So they sell bonds to the market. So you can invest into bonds. You get they increase the interest rates on the bonds so that you get a better yield back when you have holding those bonds. And most often it's actually not the people, is central banks they sell it to, or other banks, and banks keep it in their reserves. They're as good as US dollar. All right. Now, that is not good for the market. Market needs money, of course. Market liquidity is the fuel of the market. It's what drives the market. And every time we have had a bull run, we have had quantitative easing. Not every time, but most of the times we had quantitative easing. Quantitative easing is the opposite. They are now buying back bonds, lowering the interest rate, so people don't want these bonds anymore, and therefore they take the money and invest it into the markets instead, into stock market. And if the yields are really low, then they run into crypto markets. More money in the markets, more liquidity, people are more risk on. So this is exactly what we wanted, and this is why the market is pumping. Let me just check the market quick. All right, pumping, but it's dumping right now. But like I said, we had all this priced in already from before. Now, QE is so bullish that it should actually send crypto much higher. So we will see. I'm remaining bullish on this. It's only the only skepticism I have right now is that we have seen a lot of very bullish news, and market has not done what it's supposed to do. We know that by now, and that is of course because someone or some guys are dumping their holdings as soon as there are good news. So there are good news, people start to buy, institutions and whales dump that on us then, or they dump their holdings on us so they can sell it as high as possible, or as expensive as possible. We buy it high, expensive, and then we get wrecked. Unfortunately, most often the retail traders are the ones taking the hit. Just want to see if there's something more. Yeah. So it's basically, this is the thing. So the news are that we are that they will stop the QT by the 1st of April. So 1st of April, when this is confirmed, expect the market to rally. I don't know who said it in our group. GG, are you here, bro? Because you said something about in the beginning of April that market will rally. Now I'm kind of convinced of that, you know. And by the way, it turns out it was the CIA that killed JFK. Trump just released the files and everything on it. But anyways, we stick to the subject. So that's where we are. What I'm expecting is with these news is that market will pull back a little bit now. We have a very extended market, but we have a strong order block down here in support of this order block. All of this here is support. Let me zoom out a little bit. All of this here, resistance, 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 and we want to flip it as support right now, right? So we have dipped above, rejected this order block here at about 86K, and that rejection is this pullback that you see here right now, and I'm hoping for it to go a little bit deeper and then start pushing up. If it comes here, I will probably add a couple of positions to my currently going trade on it here. Yeah, man, we broke down hard. So when we come down to the 84,800, about 85,000, no, sorry, 84,800, that level, that vicinity, I will add. If not, I will not add. That is just, it is what it is. But it looks like it wants to turn now already. It's giving some turning candles, but I didn't know that we were in a 1 minute. So let's go to the 5 minute. All right, we need some turning confirmations before we know that this thing is turning up again. Yeah, but the momentum in the market is lost. The fundamentals are there. Let's see how high they can push up the market with these fundamentals. Unfortunately, there's a lot of liquidity trap below, and let's see what our insider trader is doing. By the way, you guys have not seen this here, right? So you guys know that we have an insider trader. Is this guy here? This is the wallet, and he just went long on jelly. I don't even know what that is. But this is the guy that shorted crypto Bitcoin for 525 millions in total. All right, let us sink in. $525 million in total. That is a sick amount. When he closed his position, I don't know if you guys saw it. When he closed his position, the market went up 1%. The entire crypto market went up 1%. That was sick. So yeah, man, that is hardcore market manipulation. Market makers were trying to take him out. We were watching it. We were talking about it, but that is not the subject right now. I just wanted to see if we could get some hints here. No, but it looks good. So he's long. This guy loves to short the market. So if he's long, then he's also bullish. So we're just waiting for this for price to come down to about, like I say, 84,800, and then I will add a couple of positions. If you are not in, then yeah, I wouldn't want to buy now, to be honest. Like, I can add because I already have a position open from 83,600, but I wouldn't want to buy now. Why? Because all this here market, like, there will be reactions, and this, all of this here is, there's a lot of unfilled order here that will press the market down again. If we look on the liquidity chart, let's see what we have above us. Yeah, come on. All right, so let's zoom out a little bit. We basically even Steven. We have just as much on the buy side as on the sell side. 7 day. 7 day, you see sell side is dominating. Like, you see all the liquidity that is here. Now, here's one thing you have to understand. In a bull market, you will always see dominating liquidity here because people are buying, and market is pushing up, right? But every now and then, and this is why you have pullbacks also. People take profits, market makers push the market down and liquidate, and then it starts going up again, all right? On the 1 day, dominating here. So we'll probably get a pullback. There's a lot of liquidity here that market will like, everybody's going bullish now. Everybody's FOMOing in now because they think the market is going to rocket with what Jerome Powell just said. So there's a big chance actually that we can come down. What did it say? At least to 82, 300. Let's look on the heat map. 83K, right? So we have this support here that we're approaching now. This is the level I was talking about, 84,800. That is a good support level. If market doesn't give good support from here, if we don't see any good support and a bounce off from here, then I think that we will actually liquidate a little bit. This was the pump, and it will be a sell the news event, and this was this here was just a bull trap basically. So we will be careful with this here. I will let the stream run for a little bit, but I will also shut down my mic and let this screen be on so you see what I'm doing, if I'm adding to the position or not. I will let you guys know, either I write on the screen or I mute myself. I'll let this run for a little while more, maybe half an hour, 1 hour more, just so we can see where the market is going and what if the market can catch some momentum upwards. But with that said, guys, if you have any questions, let me know in the chat. I will answer them, even if I'm muted. And guys, please go berserk on that like button. Smash that like button, man. I know that this stream was not the best with the FOMC lagging, but anyway, smash the like button. Just for good vibe's sake. Thank you, TikTok Familion. All right, guys. I'm muting myself. All right, my people, whoever listens to me and is still here, I'm closing this thing up. Nothing is happening. Momentum has died, but it looks for me, just last words I can say is, it definitely looks for me like it wants to break higher. Because, let's just do this quick before we wrap this up. We are in this order block. Market should turn from here. We have left this undecisive candle, which is basically, it's a dangerous candle because it's a reversal candle, market reversal candle. So market could shift from here, but right now it looks like it's pushing, it's testing, it wants to go higher up. So we will see. But there's no volume in the market. Anything can happen when there's no volume. Somebody pushes in 10, 50 mil and it goes in that direction that the person wants. So we're leaving it as this right now. Last thing I want to say also about XRP, I was looking at something. This here is a bullish flag pattern. So this is also why I think it's going to go higher. So I think right now market is just, you know, stalling out from all the pump that we have had, and it's going to break out eventually, hopefully, and then push higher up. So we're going to have some retrace, and then we're going to see a higher market. That is for XRP. That is for BTC. It's all the same across the board. All these pairs, or sorry, all these cryptos are at major order blocks and resistance right now. So they need to break through. But in the same time, the fundamentals are super bullish. So what came out today was, I'm not going to exaggerate, say super bullish, but it's very bullish. So that's it. I'm going to leave with 2 gems before I finish this stream, because I see that some people came in. ACH, start accumulating it. This one, like market can dip, it can crash, it can do whatever you want to do, but sooner or later this one is going to rip. It has major utility. It's in the PayFi sector, so it means it intertwines regular traditional finance system with DeFi, so crypto blockchain finance systems, and that's what's needed for adoption. So that's a narrative that I believe is going to be very big. It's going to be huge because it's needed for the adoption of crypto. So ACH is super undervalued also. It's super oversold, super undervalued. So this one accumulated, DCA into it, super discount on it right now. And another one I want you to leave with. I bought it today actually, or I bought more of it today actually. I bought first time somewhere up here. And this one also super undervalued. That's Virtuals. Virtuals is super undervalued. Why is this project so good? Is because it's like a pump.fun for AI agents. But some of these AI agents be very serious, or it be some very serious projects on this. So the team behind it is very good. They are very strong. They are very serious about what they do, and have a lot of they build it in scalable ways. So this project is very scalable, and they're very dedicated and passionate about what they do. And it has already gained a lot of popularity, and of course hype died, market died. It's mega oversold right now. So when this one catches up, it's like 10x just to get to previous high that we had in January. This is in January, so it's not a long time ago. So Virtuals, ACH is my last gems that I give to you before I wrap the stream up. I think the market is going to go a little bit sideways down. Maybe BTC might come all the way down to 84,500, but I think it's going to push higher after that. We will see tomorrow morning what kind of breakfast this serves for us, all right? With that said, take the action. What the heck? What is XAIZ? I think this is bots writing. All right, guys. So with that said, have a beautiful evening, and I will see you guys tomorrow, all right? Peace.